Welcome to the Hardman Co and GrowthInvest Tax Advantaged Forum on VCTs. My name is Brian Moretta. I'm Head of Tax Advantage Research at Hardman Co, and I will be comparing today's webinar. This is the third of these that we have run. It's the first VCT one, and we've been titled Growing Poor in Taxing Times. I think it's very timely. Given what's happening next week with the budget, they were thinking about things that can help people save tax as well as get really good investments. We have four great managers. Each has a very distinctive way of doing things, and they're going to each have a chance to tell you a bit about what they're doing. The format is each will give a 10-minute presentation. That will be followed by Q&A. If you want to pitch in any questions for the Q&A, then please do so reasonably promptly during their presentation. If you've got a more general question on VCTs, we hope that we'll have a bit of time at the end and we will get everyone together for perhaps a wider discussion. So now what I'd like to do is introduce Steve Dobson, who is from GrowthInvest, and he's going to be helping me run this event.
Right, thanks for that, Brian. Yeah, my name's Steve Dobson, Head of Investment at GrowthInvest. For those that don't know, GrowthInvest basically provides administrative services for tax-efficient investment in to advisors. So we cover EIS, VCT, IHT product, and participated with Brian on the previous EIS. And yeah, just to reiterate the format. If you have questions, anything comes up during the presentations, please post them in the chat, and then we'll direct them at the presenter post the presentation. And then if there's time at the end, we'll do a general Q&A where we can cover more broader topics. Thanks, Brian.
So I'm going to kick off with a short presentation. So I'm going to cover a few things that are in common around VCTs. I know we have some very sophisticated, very experienced investors and advisors on this forum. So I'm going to go over this reasonably quickly, but in case anyone is relatively new, I hope you'll find this informative. So the first thing I want to mention is what is the case for investing in venture capital? And while we're all attracted by the tax reliefs, I think it's really important to say, to make in this case, we want to make sure it's an investment-led sort of decision. You'll don't have to spend very long in the industry before you hear the phrase about the tax tail wagging the investment dog, and we're all trying to avoid that. And fortunately, there is a good case for investing in venture capital. If you're investing in venture capital companies, they are doing something that's distinct from what a typical quoted company does. So if you think about what they're doing, they're trying to find that first customer, they're trying to create that minimum viable product. They're doing things that in some sense are economically independent in perhaps the way that a quoted company is not there established. How they behave depends often on how well the economy does well. So venture capital companies have sort of benefit of correlation reduction, so they fit in part of a portfolio very well. However, they're not entirely independent because at the end of the day, you want to sell your companies, and how good the exit is depends on how much money the buyers have, and if quoted companies are doing well, they're often buyers of these companies, or when a company is good, that means you get better prices. But the net effect is venture capital has a diversification benefit in the portfolio. So if so a bit like equity and bonds, we all know that they're not quite the same, so having a bit of each in the portfolio helps. Venture capital is a bit the same, so it's not as good to diversify relative quoted equities as bond, but it's still quite good. It's better than, say, private equity. I think if you're thinking about this, I wrote a paper a few years ago on asset allocation. So it shows how you can add that venture capital portfolio with that to improve your expected returns, but without actually increasing the overall risk. You have to adjust other assets to sort of balance that. I think for advisors in particular, this is a great chance for you to add value because you can actually give investors a better outcome, and show your knowledge. So, but typically, for above average or an average risk investor, the math suggests kind of low teens in venture capital is maybe where you want to start thinking about getting to. So, as we're talking about VCTs, venture capital trusts, a quick introduction to what they are. So, venture capital trusts are a closed-end company. That gives them nominally a fixed pool of assets. And I think that's very important in an asset class that is illiquid, like venture capital, because that means that they can't be forced to sell anything. So if this was run an open-ended funds, people might take the money out and they'd like have to do things with fire sales. And we all remember a very famous fund manager a few years ago who ran into problems with exactly that issue. It's not entirely fixed in that you can invest in these things, and typically what you want to do is invest by buying new shares. You can, in theory, buy them in the secondary market, but if you get in with new shares, you get all the tax release, which is generally what people want. Generally, you'll find that these are not available all the time. There are specific offer periods, and most of the people today will refer to that. And you'll see people talking about limited amounts. So they don't want to have too much cash. You don't want to dilute. There's rules on how much cash they can hold. So that means that they offer a specific amount. So, for example, when Paul talks about Northern ones, one of their VCTs wasn't raising as much as the others, and that offer for this year is already closed when the other two are still open because it was raising, because they're raising a bit more. If you think about where you get your return from, well, there's two ways of getting returns from a venture capital trust. What people usually think about are dividends, and you get a stream of tax-free dividends, and that, I think, for most people is the main attraction. And then you can also sell them. You sell them as normal share because they're a closed-end company and there's no secondary buyer. Most companies have a buyback policy, and if you're looking to buy some shares in VCT, I would really strongly suggest check what the dividend policy, what the buyback policy is, and that will help in decision making. So I mentioned tax reliefs are not everything, but they are very important. They're pretty simple for VCTs, so long as they satisfy the rules. On entry, you get up to 30% of the amount invested. That's for up to £200,000 invested in a tax year. And what I should have also added is that you have to hold them for 5 years to keep that. If you sell within 5 years, you then have to repay the income tax relief. So that can be worth watching out if you think that might happen. Dividends, all dividends are tax-free. Can't be simpler. And capital gains tax, there is no capital gains tax payable on exit, which is also quite simple. So all in all, I think, very straightforward. I will move on to introducing our first presenter. So we're going in alphabetical order. So our first presenter is going to be Nick Pillow, who is a ventures director at Blackfinch, and he's going to tell us about all their exciting technology investments. Over to you, Nick.
Thank you, Brian. Yes, I'm going to give you the whistle-stop tour of the Blackfinch Spring VCT. I should say our own disclosure that we are FCA regulated. This is a high-risk investment, and what I say is not financial advice. Blackfinch itself is a multi-asset investment specialist led by Richard Cook, with a heritage going back over 30 years. We now have over 150 people across the UK and over £900 million assets under management. Our investments include renewable energy, property, even forestry now. And our solutions span from inheritance tax planning through to managed portfolio services. And the ventures part that I'm a director in covers our ventures EIS portfolios and the Blackfinch Spring VCT. Both of those invest in early stage technology companies. And we're particularly looking for companies with that sort of profile you can see there, where the companies are not just having the potential for good, solid linear growth, but that sort of explosive potential to generate orders of magnitude, growth. Of course, it's not always an easy journey, and we don't get involved at these very, very early stages over on the left. We are always looking for evidence that the founders are really capable of delivering and delivering at pace. We want evidence that there is commercial demand for the product or service that they are selling. And for the VCT, where we aim later than our EIS, we really want them to have built out that team and to know what it takes to get the customers to support them and deliver the revenue. And they need funding to do more of it, to scale up, to deliver that really exciting growth. It's never quite the smooth journey, and we do also then diversify over that stage. So some are slightly earlier, some slightly later, balancing out the risks and rewards across the portfolio. We also then diversify by sector, and we've now built 35 companies into the portfolio with a really wide range of sectors. We invest in technology, but of course that spans the whole economy these days. And you can see down in the left, we've got things like health and well-being tech, like helping elderly people at home. We've got companies powering the digital economy with, for example, advertising technology that doesn't involve personal data. And we've got more physical sectors like construction technology for new building projects, or even industrial processes. And all that diversification portfolio is designed around delivering dividends in two ways. First of all, regular dividends, and we target 5% a year regular dividends. We've now done that for 2 years running, having only launched 5 years ago. But also the potential for special dividends. And one of the nice things about the size we've got to is we've got that broad diversification, but if we get a nice juicy exit, the return from one investment, it still can provide, has the potential to provide, a meaningful special dividend to all the shareholders. Our minimum investment is £3,000, and we take then fees by default, initial promotion fee 2.5%, and then an ongoing annual management fee of 2%. And there will be a 20% performance fee, but only when we've reached a value of £1.30. And I'll come back to that in a moment. And there's the 5% discount buyback relating to Brian's point earlier. So the default initial promotion fee is 2.5%, because we also have an early bird offer, so the 1% discount on any applications up to 15th of December, and there's a 1% loyalty discount for any existing Blackfinch investors at any time on top of that early bird. Blackfinch has many teams to support the investments because of our group nature, so legal, compliance, technology, but the ventures investment team itself, there are 12 of us. And we have a really interesting mix of experience within the team. Several of us are startup founders. So Richard Harley, for example, on the left there, or in my case, my background was in working in technology companies, very high growth, successful companies, and the big enterprises like Nokia that bought them out. And then I went on to co-found and run my own startup before joining Blackfinch 6 years ago. We've also got technology experience. 3 of us have got engineering PhDs, which is very useful in the very more technical companies we look at. And of course, we have finance experience. So Kim here, for example, with a background in mergers and acquisitions. The other thing to say about the team is we work very collaboratively together. We're not going off finding our own investments. We're all working together to decide which are the right investments to take forward to add into the portfolio, and how best to support the ones that are already in that portfolio. And in doing that, it's not just us. We also have a network of over 100 venture partners that we can draw on. And these are the people we add to the boards of our companies, people with real experience, whether that's in a particular type of business. So, for example, Geraldine Osman there, who is brilliant at marketing, or it's industry expertise. For example, Libby Chambers on the right, who is very much involved in the world of finance technology. She sits on the boards of Wise and of TSB, as well as one of our portfolio companies. So it's that all experience together, ours and the venture partners. How's it going? Well, I mentioned we launched 5 years ago. The first shares issued March 2020, just as the country descended into lockdown. And of course, as with any VCT, or should I say any successful VCT, there's been a bit of a J curve since then, because initially we haven't, we'd made no investments right at the start. We were incurring costs. The NAV per share came down to about 89 pence in 2022, but then the performance of the investment starts pulling that back, recouping it to back to the pound level. We started paying dividends, and now we're up to a total value assets of 64 million, with a NAV per share plus the dividends, that value returned to clients of 106.7 pence. And this is the reason it's a great time to get in now, because remember I mentioned that our performance fee hurdle is £1.30. There's still a good 23 pence to get up before we start taking any of the increase in value that is going to shareholders and to investors. Just to show that slightly more accurately, quarter by quarter, that's the actual curve we've been on. And you can see in the top right there, that darker color, those are the dividends we've paid out, where we're returning more value to investors. And as I say, we've now paid 2 full years of 5% dividends a year, and it's very much our target to maintain those regular dividends alongside the potential for special dividends. Just to give you a couple of examples, because it is all about the companies in the portfolio ultimately. If you go abroad, get one of these. It's a currency card. It's a travel debit card that saves you all the extortionate bank charges and marked up exchange rates you get with the high street banks. What's special about this one is that you don't need to move money into a separate account in order to pay. It just links directly to your own bank account, in my case, Barclays. And it is exactly like paying from my own account, but without all those charges. It is so simple. The really exciting thing from an investment point of view, though, is that same technology linking into any bank means they're able to offer loyalty debit cards. And the first major one they launched was with Hilton Hotels, so if you have the Hilton Honors loyalty debit card, that is powered by currency, and it's driven a lot of interest from other major multinationals who want their own loyalty debit card. And then Spaceflux, our latest investment, which is monitoring what's going up in space. It's amazing technology, such precision to be able to track things as small as 2.5 centimeters across, whizzing around the Earth at unbelievable speeds. And it's getting really important because it is getting congested up there. More and more satellites going up, a lot of debris, and commercial satellite operators want to know what's going on. Governments really want to know what's going on up there because there's a lot of aggressive maneuvering going on amongst certain satellites up there. So increasing demand. Spaceflux is the company keeping an eye on what's going on up in space. So that is the Blackfinch Spring VCT with our expert team, including that mix of technology, finance, and startup experience, supplemented by our value add venture partners. And then the regular dividends, 5%, plus that nice size where we've got good diversification, but still the potential, for some, really interesting special dividends. And of course, that high hurdle for the performance fee, where actually there's still quite a lot of value that you can get as investors before we start taking our performance fee from that. That's it. Thank you very much.
Thank you for that, Nick. Very, very informative. We've got a couple of questions that have come in. The first one I'll pose to you is the NAV return excluding the dividend return?
So the NAV return that I showed that's the NAV total return. You mean on this slide?
It must be related to that slide, correct? Yeah.
So dividends are part of that, yes. So that would be, what's the the value of the NAV at the starting point to what's the value of the NAV at the end of the period plus the dividends paid within that period.
And it's termed NAV total return, isn't it, with the dividends backed into there? Perfect. Cool. That answers that one. And then I think you've mentioned obviously the VCT is relatively new, 5 years. You've had it. I guess what was the thought process for Blackfinch, I guess, to add it to your product offering, given you had some other products there already, and also how easy or tough has it been to grow to the size you are today of the 64 million?
2 parts to that. So first of all, the reason we added it was because we were being asked for it. We provided the EIS product first, and it was a natural extension to be able to do that from a client point of view, but also as a vehicle then providing some follow-on funding for the well-performing EIS companies. It was very hard to get off the ground, and I'm sure everybody else would tell you the same. That first 3 million that we got was very hard won. I would say since we started paying dividends, it's become much easier to grow, and we've been very pleased with the growth that we've seen, and 24 million brought in last year. So now that it's got going, it's going very well.
Perfect. Good to hear. And then lastly, it's been a tough environment over the last few years, as you've mentioned, with regards to exits. And this isn't just for VCTs, this is just for companies as a whole. Has that made you pivot at all in the way you think about selecting companies or the investment strategy?
We always look long term in investments. We've got to sort of try and predict what's going to be happening, and so we've always got to adapt what we are doing, looking at what's actually going to be successful, not right now, but what's going to be successful in 5 or more years' time. So yes, it has been hard in terms of exits. And from that point of view, we've encouraged some companies that have had approaches to hold on because we think they get better value further down the line. But I don't think that's materially changed the fact that we're always just trying to look ahead. We're adapting anyway to what is likely to give the best returns at the point of the exit, as I say, in 5 or more years' time.
Our next presenter is Richard Roberts, who is Head of Sales Development Foresight Group. Foresight probably need no introduction, being one of the largest managers of pretty much everything in our space. And they have a range of VCTs, but I think Richard is going to focus on one very in particular. So, Richard.
Well, good afternoon, everybody. Thanks, Brian. And great to speak to you about our Foresight Technology VCT for the next 10 minutes or so. Just a quick intro to me. I'm Head of Sales Development at Foresight Group. I've worked in sort of venture and private equity for sort of most of my career. And my kind of core role at Foresight is to engage both with advisors and investors and help sort of bring them a little bit closer to their money and understanding how Foresight's VCT product suite and EIS suite work. I'm not going to dwell too long on this because you'll see enough of these today, but obviously this is a financial promotion that you're going to receive today. So I'm going to start with a stat, which is going to shock you perhaps, but 85% of VCTs in the market are classified as general enterprise. What that means is that they have similar investment strategies and ultimately provide little potential diversification for investors. Now, that's a pretty punchy statement, but since sort of the patient capital review, the market has had to sort of narrow. So although many VCTs will have some technology, they will also have a range of e-commerce. They might hold some AIM in there. They might have some manufacturing. They might have some healthcare and a broad range of different general enterprise sort of assets. What I'm going to talk to you about today, though, is a specific VCT within that, which is the Foresight Technology VCT. And 3 reasons why you should look at considering this in your portfolio for VCTs this year. So number 1, this is a highly differentiated VCT, and it's managed, as Brian said, by Foresight Group, which are one of the largest managers in the space. Ultimately, within the space, as I said, it's quite congested with general enterprise, but the technology VCT specifically is looking at deep tech, sort of early stage companies which are highly differentiated, they're high growth potential, and we're sort of looking at delivering that sort of 10x return sort of profile. So that should, because it is so focused, give you a little bit of a better portfolio diversification than going into a general enterprise bucket. Number 2, what are we looking to do? Well, the deep tech VCT is looking to solve some of the world's most pressing challenges. Okay, we're backing companies that have got huge growth potential, but really we're addressing some of the key problems that we're all going to find for tomorrow. So climate change, resource scarcity, cybersecurity, and so on. And lastly, there are some very strong tailwinds to invest into this sector now. So some strong government support, obviously through things like VCT and EIS. There's a great ecosystem for investing into deep tech. And ultimately, there's some great market timing. And the Foresight Technology VCT has been going for about 5.5, 6 years. And it's getting to that maturity window. So it's a great time to start looking at sort of building this into your portfolio. So in terms of the strategy itself, what are we looking to do? Well, as I said, we're looking to solve global challenges. Okay, these are things that are ultimately going to make a difference and are significant problems to everybody's lives and the way that we sort of are living our lives. And the focus of the VCT is ultimately to address some of these. So, companies developing and addressing these problems are called deep tech companies. So they're looking at investing into a range of different underlying technologies, as you can see here. So robotics, autonomous systems, advanced materials, semiconductors, things that are ultimately going to make a significant difference into the way that we live our lives. And this is really a very deep niche focused fund. It isn't very broad in terms of the way that we are making investments. Okay, and this range of breakthrough technologies is where we spend our time and effort originating deals. And how do we go about doing that? Well, ultimately, the UK is a great place for investing into this type of business. Okay, and the raw material for investing into deep tech companies comes from intellectual firepower. So 12 out of the top 25 universities in Europe are in the UK. Okay, and that provides the raw material ultimately to start looking at the problems of tomorrow and beginning to solve them. We've also got one of the most active venture capital and startup VC networks in the world. It's sort of, with VCT and EIS funding, it is the envy of the world. And that's all supported by a set of government initiatives that are really harnessing that deep tech theme and helping UK PLC sort of grow. And why is that important for sort of the technology VCT itself? Well, ultimately, Foresight has a regional office network that sort of sits almost right on top of all of these academic and financial ecosystems. You'll all be well aware of the Golden Triangle of Oxford, Cambridge, and London, but it's not just unique to that. Places like Bristol is a hub for semiconductors. Places sort of in the Northern Triangle are great for industrials and material sciences. And Foresight has an unparalleled regional access to this type of deal flow. We have 14 different offices up and down the country, which helps us originate these deals. We're working very, very closely with these early stage spin-outs, a lot of them from universities, but generally from the ecosystems that they're producing. And that gives us access to the deal flow and a massive competitive advantage from some of the companies within the VCT marketplace and network. And that gives us a great opportunity to build some fantastic companies for you and your clients to invest into. So when it comes to actually investing, what are we looking to try and do? Well, obviously, we're looking to try and back innovative businesses, but critically ones that have got strong intellectual property that's defensible. That's going to be the platform for us to actually sort of both protect and drive value for investors. We're looking to back companies which have got some outstanding, commercial expertise and pedigree, and a team that's sort of potentially been through this before and has a great story, in terms of being able to raise capital. They are solving a very material problem, and we'll talk about a great example as to what that might be in a minute. And we're not looking to sort of drive unicorn value for all of these companies. We're looking to try and ensure that all of these companies, when we're making an investment, has got a clear route to exit. And it's exiting in a range where we can both make an investment return in a meaningful amount of time, but also ones where there is, an investment opportunity for buyers for the future. So we're trying to ensure that we can return capital on a regular basis. And ultimately, we're trying to drive exit value from financial multiples. We're not trying to build traditional businesses here. We're looking to invest into high potential deep tech companies that are going to be bought for their intellectual property and capability. You'll see lots of these types of sort of screens today, and investment teams from the other managers. This is the Foresight Venture team, but it's part of a wider team. Foresight have one of the largest private equity teams in the market, with over 60 investment professionals. And we have a wide range of industry expertise that we can lean on from venture partners and our wider network in order to help us both do due diligence and assessment for making those great early stage companies. And because we've only got 10 minutes, I just wanted to focus on one company which was in the strategy. So this is a company called CodePlay. CoPlay was a spin out from the University of Edinburgh. It was a chip manufacturer, a semiconductor manufacturer. And ultimately, what the focus of CoPlay was to enhance the performance of computer chips running AI software within existing businesses. So ultimately, what we were doing was looking to enhance existing companies that were in there. So within our exit for CoPlay, we took a business from early stage university spin out. We created over 50 jobs with that money, working closely with the University of Edinburgh. We helped the business secure a landmark deal with the US government to help it sort of underpin some of its next generation supercomputer. And we helped it build a go-to-market strategy that could really sort of add value to things like driverless cars, high potential computing, AI, machine learning, and so on. And that is sort of something that's become until the last few days, where the AI bubble has potentially softened a little bit. But ultimately, AI is going to drive the way that we live our lives, and ultimately, computing firepower is going to be the thing that's going to deliver that. So this is a great example of a deep tech business in action, and ultimately taking it from that cradle to grave and delivering a fantastic exit for investors, something that we're extremely proud of. In terms of Foresight itself, you probably are aware of Foresight, but the private equity capability specifically, why should you choose Foresight as your counterparty to invest your client's money, for example? So we're a very large business. We have 13.5 billion of assets under management, and that is split across both institutional and retail money in the infrastructure and private equity space. We've got 19 offices across the globe. As I said, we've got one of the largest PE teams in the UK with over 60 investment professionals. And more importantly, we know what we're doing. Okay, we've made over 400 PE and venture investments over the last 10 years. We've delivered well over 100 exits, and the average return on investment for SMEs is sort of just over 3x. Okay, and that's full and partial exits since 2010. We've been well recognized for this. I'm not going to go through all of these, you can sort of see, but ultimately this is credentializing both a process, a team, and a focal point for our Foresight Technology VCT. But we don't just have a Foresight Technology VCT. We do have a wider suite of VCTs. We're only talking today, or I'm only talking today around our early stage specialist deep tech Foresight Technology VCT. We do have a venture VCT, which is slightly later stage, investing in more into enterprise software, sort of Series B and beyond, things that have got better product market fit. And then we also have our general enterprise, that 85% bucket that I mentioned right at the start, which is much later stage and much more sort of traditional proven businesses. So we do have a very broad range of product offerings for that VCT market. But if you are ultimately looking to differentiate and build a broader VCT portfolio, you should really look at the technology VCT as part of that. And why is that? The things that you need to take away from today: it's highly differentiated. It is a relatively new VCT in the grand scheme of things, but it's still got the award-winning fund manager pedigree. Okay, and that differentiated VCT can provide you better portfolio diversification. You're not just investing continually in the same sort of general enterprise area. What is it doing? It's solving some of the world's most pressing challenges, the things that are going to create a paradigm shift in terms of the way that we live our lives, addressing things that are very relevant to us today and generations for the future, and really solving some of those world's most pressing challenges. And lastly, there are some strong tailwinds to invest now. The portfolio itself is entering its maturity window. It's getting to that stage. It's about 6 years old since inception. There's been early stage growth, and now it's the inflection point which would really deliver value should you want to sort of broaden out. And obviously there's a lot of money going into this space ultimately because of the ecosystem, government support through things like VCT and the EIS money, and market timing. So that's me. I'm probably over time, but happy to answer any questions.
Perfect. Thank you for that, Richard. You've drummed up a few questions here. There's going to be one general one on AI, but I'm going to save that till the end for all the panelists. I think it'll be an interesting one for people to talk about valuations there. Given Foresight Tech VCT is earlier stage, what is the failure rate for companies? And how does it compare, I guess, to your later stage VCTs?
Yeah, so maybe I'll answer the later stage one first, because I think that we need to look at how we're investing. I think failure rate within a VCT vehicle, is less acute in one sense, because ultimately you're investing into the VCT and the broad portfolio. Our generalist VCTs, they're much later stage. They are much more sort of traditional businesses that have got revenue that need money for capital growth. So on that side of the ledger, there are few failures, because ultimately they are more proven businesses. In sort of obviously investing into early stage deep tech, there is a high degree of risk that's going to go with this. I don't know have the actual numbers off the top of my head, but out of a portfolio, I think that of sort of 48 companies that are in there at the moment, there's probably a small handful that are either failed or probably not going to make it. And that's okay. That's part of the investment strategy. We are not here to just deliver 1 to 3x return and protect people's money. This is why this is a diversified VCT from the mainstream market. We are swinging for the fences. We want to deliver 10x plus because we're solving some very big problems, and we're not going to get it right every time. But if you're buying a basket of companies within the VCT and the tech strategy, and you believe in that strategy as a great opportunity, on balance, it will deliver some great results.
Perfect. Thank you. Another question on Pisces, the new framework for private markets, of which LSE is going to be is going to offer a version of Pisces. Is this going to improve deal flow in any way in terms of an exit opportunities for companies in the portfolio?
Yeah, I'm not sure it will improve deal flow. I think the deal flow and the ecosystem is very strong in the UK, and it's not just all in the southeast. I'm here in Belfast today. There are huge opportunities right across the UK, providing that you can get your network into it. And that's why Foresight's sort of reach with its regional office capability really sort of harnesses that deal flow. What I think it will definitely do is it will help with that exit potential, because ultimately there's more capital and there's more liquidity coming into the market, hopefully, that will be able to pick up businesses and really drive them on for future growth. So I think it's on more the exit side where the value add will be rather than the deal flow.
Yeah, I agree. There's another question that's more general on timings with the budget coming in. I'm going to leave that one till the end for everyone to participate with. But the last one I have really is timing of the raises themselves. Obviously, you've got the 4 VCTs, 2 of which are open now, 2 are going to open in the new year. How do you decide when is the right time to open the VCT for a fundraise?
That's a great question. It obviously sits with the board, because obviously we're the manager. The board will make the decisions. Ultimately, the management of the VCTs is driven by 2 things. How much capital do we need to support the existing businesses that we've got, and how much capital do we meaningfully think we can deploy across the next sort of 12 to 18 months and support new businesses. So what we're trying to do is give everybody a little bit of time. So Foresight Technology opened in September, sort of mid-late September. Just to sort of echo some of what Nick said, there is early bird discounts up until the end of December. So we're trying to allow each one to have its own time in the sun, but ultimately it's driven by what are the requirements for the existing portfolio, what the team can see for new deals to support.
Thank you. I'm going to hand back to Brian now.
Now we're going to move on to Will Clark, who is Head of Business Development at Guinness Ventures. Guinness are another relatively new VCT, and they also have sort of an interesting strategy.
Thank you, Brian. Hopefully you can see the slides. Just going to make sure I can see them slides. Good morning, good afternoon, everyone. Thank you very much for taking the time to join the session. Pleasure to be here representing the Guinness Ventures business and the Guinness VCT. As a business, our aim is to provide investors, advisors access to early stage growth businesses in the UK. And we do that alongside EIS, Enterprise Investment Scheme, but also VCT. So I'm going to be talking today about Venture Capital Trust, the Guinness VCT. I've got 10 minutes for the prepared slides, and my aim with that is hopefully for you to leave this session with, firstly, a good feel for our investment strategy. Secondly, a good feel for the progress we've made since launching. So we are a relatively new VCT, which I'll touch on, but we feel like we've hit the ground running. So I'm going to talk through the progress we've made. And then finally, yes, I want to give you some reasons why to think about Guinness and our proposition when allocating to VCT in the current tax year. Before I move on, really important risk and performance notes, which are specific to early stage investing, which comes with significant risk, not least around liquidity. Just a little bit of background on us as a business. So Guinness Ventures sits as part of a broader, larger business called Guinness Asset Management. We're an appointed rep of that business. And the bulk of our group AUM actually sits under the banner of Guinness Global Investors, which is a long-only equity fund management business, and that manages around 8 billion for investors. We do plug into things like group compliance, finance, etc., and we certainly benefit from being part of a larger group. But given the nature of our investments, we have our own investment team, investment approach, etc. In terms of our sort of track record within early stage, so we've been investing in early stage growth companies for a long time through the Guinness EIS, and we're very close to having invested 300 million into early stage businesses via the Guinness EIS. Lots of exits, so over 100 million returned to investors via our EIS portfolio. That gave us the confidence, the prompt to sort of launch the Guinness VCT, which we did. We actually launched the first offer in Q1 22 before listing in Q1 23. So we're just over 3 years old, so relatively new. But as I say, I'll talk to the progress we've made in that period. In terms of our strategy, and this actually is shared, the VCT and the Guinness EIS. We participate in Series A investment rounds. So broadly, the investable universe for qualifying opportunities within VCTs would broadly fit within seed and Series A. Occasionally, we might see some deals that are slightly later on, but broadly, it's seed and Series A. So really, the options available for us would be to invest in seed, invest in Series A, or to invest in a combination of those. Our preference is scale up, so Series A. So we participate in that round. We filter for companies with at least £1 million of revenue. And just to give you a feel for that, so we've made 10 investments over the last 12 months, and on average, those companies were turning over just over 5 million. So by no means huge businesses, and certainly not bulletproof, but what we like is the fact that they're partway through their growth journey. They've been able to demonstrate a degree of product market fit. They've got customers prepared to pay for what they're doing as a product service. So we like entering at that point. Also, we're investment managers, and we want to, where possible, act on evidence. And going in at Series A gives us the opportunity to delve a little bit more into data, particularly around revenue. So we can look at things like revenue growth, which is a key metric that we'll look at, customers won, churn rates, etc., cost of growing revenue. So there's just a little bit more that we can due diligence as managers. A little bit more on our strategy. So we're based in London. We've invested across the English region, Scotland, Northern Ireland. We don't have a particular regional remit. In essence, we're looking to invest in the best possible businesses wherever they happen to be. We are generalist in our approach, but we do have 3 core sectors that we focus our attention on, and that's sort of where our portfolio sits. First is business productivity, business services, which is software. So software as a service companies, B2B type platforms. Secondly is consumer, so consumer brands and products. And then finally, healthcare. So we invest across those sectors. We think different sectors have different attributes. So we're looking to build sector diversification within the VCT. I mentioned the revenue. We tend to invest as a business about 2.5–3 million into a new business, and that would be split between the EIS and the VCT. So pretty sizable commitment that we're making. And in terms of the progress we've made, so sort of it was alluded to earlier, it is quite daunting launching a new VCT. There's significant barriers to entry, and fundraising can be a challenge. So the whole premise of launching was that we'd be plugging into the existing deal flow that we have as a ventures business, and it's been very pleasing that that's come to pass. So we've been able to scale the VCT very quickly in terms of portfolio. So 22 companies already within the portfolio, 10 added over the last year. Very confident that we'll be adding to that significantly before tax year end as well. So already building a sort of nicely diversified portfolio. In terms of that portfolio, more than 50% of those companies are growing their revenue by more than 50%. Really pleased to have also achieved our first partial exit in April this year from a company called Plotbox, which I'll talk to a little bit more shortly. And I mentioned the average revenue point. Overall, we're really pleased with the progress we've made, and I think we're nicely positioned for the current offer, which is our fourth offer, which I think has a good chance of sort of turbocharging our AUM within the VCT. So a bit more on that. So we've been open for a little while now. So we launched in mid-September. The offer covers the current tax year and next. We're looking to raise 10 million plus 5. We've got a relatively aggressive early investment incentive, which tapers down over time. The maximum early investment incentive has actually already expired, so there was a 3% discount to initial fee. But we're still at the 2% level, so pretty attractive until the end of the calendar year. And we also have an additional discount for existing Guinness VCT investors. So dividend is obviously a really important part of the VCT mix and sort of a key driver for inflows within the space. A feature, and I suppose not a positive feature of a new VCT, is that you're not typically able to pay a dividend immediately. So we haven't yet paid a dividend, but we're really pleased that the board of the Guinness VCT have announced that they intend to announce a formal dividend to be paid in April 26. So that should be our first, and I think that kind of puts us in a different category, and hopefully, as I say, will mean that this offer is larger in size than our previous 3. And just a little bit more about that. So any investor that sort of applies and is funded by the deadline for the current tax year, so 25-26, which is likely to be the 1st of April, should be in receipt of the first dividend in April as well. So portfolio-wise, so yeah, as I mentioned, so 22 companies there. You can see the spread, all of which are co-investments with the Guinness EIS. So any company that passes through our investment committee and process is available for investment via both the Guinness EIS and the Guinness VCT, all things being equal. So there will be some allocations decisions made between the two. So there's some relatively new companies to Guinness, but also, so if I pick out names like Aptem, we first invested in that business in 2018, and Baby Mori, for example, which is sort of high-end baby clothes, turning over about 20 million. We first invested in 2019. So businesses we know very well that we've been able to back via the Guinness EIS, sorry, the Guinness VCT, as well as the Guinness EIS. In terms of sector split, so yeah, nice split between our sort of three core areas of focus. That will move over time, but broadly we're looking to achieve a good level of diversification between those 3 areas. Just to give you a few examples, and I'll sort of whiz through these, slightly conscious of time. Risk is an insurance tech business, so would fit within our software section of the market, and in essence it sits between car brands and insurance companies, and it enables the car brand to offer branded insurance at the point of sale and at other points during the lifetime of ownership. The strength really is, I mean, for the car brand, it's additional revenue. For the insurance company, of course, also revenue, but in effect, it's allowing the car brand to do their sales and marketing for them, and consumers have a much stronger pull towards a car brand versus an insurance company, for example. Next one, consumer business. So within our consumer sector, eco deodorant. Really interesting business, probably one of our most well-known portfolio companies, partly because they're on Dragon's Den and they received some funding on Dragon's Den, but also they're really good at their advertising, so they're out there. First backed this business in the 23-24 tax year, turning over close to 6 million. They're very close to 20 million revenue for the current year, so really flying in terms of their revenue growth. Finally, Plotbox. I referenced this earlier because we partially exited this holding. software business based in Northern Ireland, and quite an interesting sector that they cover. And it's called Death Tech is the sector, and their clients are cemeteries and crematorium businesses, both in the UK and the US. And their sort of expansion into the US got the attention of a US smallish PE firm that made a sizable investment, so $20 million into Plotbox in April this year. And to facilitate that, we sold down 20% of our holding at 2x. So that's really great to have our first exit within the VCT. Just going to close on just some thoughts around valuations, and I sort of will bring this back to the Guinness VCT. And what we're showing here is a basket of 70 listed software companies and their revenue to value multiple over time. And sort of the valuations during COVID have been, widely reported. A lot of people read up about them. They're extremely high during that period. Lower interest rate environment, a lot of sort of hot money coming into the software sector. But you could probably overlay this type of graph on most sectors within growth. What we have seen subsequently is a recorrection, rebasing, whatever you like to call it. I bring this up because all of the Guinness VCT's investments have been made since Q1 23. So we're quite happy with the entry point that we've been backing these businesses. Clearly not a guarantee of success, but I think we're quite happy with valuation multiples that we've been able to achieve within the portfolio. So that's the prepared slides that I have. So very happy to answer any questions.
Yes, thank you for that. I think you've answered one of the questions, which was regarding the dividends, about when Guinness VCT is going to start paying. Are you able to shed any light on roughly how much that would be, and is that going to be split over into 2 dividend payments over the year?
Yeah, and I can't give details, but we're expecting to have the details announced in early 26, so January, sort of early part of January. I think there's a good chance it could be split. So I think we're targeting 5%. Hopefully we can achieve that next year, but I think if we do that, it would be split between an April payment and perhaps a payment in summer, late summer, something like that.
That makes sense. And then from the same person, actually, the question, I guess, given there's a lot of co-investment with the EIS as a kind of indicator, what failure rates have you seen within the Guinness EIS?
Yeah, good question. So we're currently, so the Guinness EIS in terms of the growth portfolio has invested in 61 businesses, and failure rates around 16-17% currently. If anything, I'd probably indicate that may move up, but that's kind of where we sit at currently.
Perfect. And then finally, I guess, given there's a lot of established VCTs out there, and we've been speaking to a couple of the managers here today, and Paul to come, why would an advisor or an investor anyway pick a newcomer VCT like Guinness? What's the kind of selling point?
Yeah, really good question. So a couple of things. I think there's probably 3 key reasons that we've had support, and hopefully we'll continue to have good support in the current offer. Number 1 is investors and advisors that sort of know us through our work within the Guinness EIS. They like our track record, like our approach, etc. So that's 1. Number 2, and probably the most important, is around diversification. So a lot of advisors and investors will allocate to VCT every year. There's not a huge pool of managers out there, so I think a new VCT is interesting in terms of accessing a new manager, new portfolio of underlying companies. So I think that's certainly where we've seen some traction. And then finally, I would probably come back to that valuations point. So certainly investors and advisors have flagged that with us. So they like the fact that we've been active only since 2023 Q1. So hopefully coming in at sort of a good entry point. So that's been flagged as well.
What is your typical percentage holding in a company in the VCT? And then also, how do you expect AI to impact SaaS models?
Yeah, so percentage. So all of the businesses have co-investments with the EIS. So I'll answer that sort of as Guinness Ventures. So we tend to have a sort of 10-15% ownership equity of a business. It can be outside of that parameter, but broadly. And then AI, yeah. So we look to, there's an expression we use internally called real world businesses, and we do certainly have sort of AI focused businesses, certainly within our software So one of the three sectors that we cover. But we like to, which is one of the reasons we like consumer. So we like bringing in some businesses that aren't necessarily AI deep tech focused to offer some diversification. But as you'll have seen earlier, I mean, software is the largest section within the VCT and across our portfolio. And certainly within those, there's some sort of pretty AI focused businesses within that.
Thanks very much for that, Will, and I'll hand back to Brian.
So our final presenter, last but certainly no means least, is Paul Mattick, who is Head of Sales and Private Investor Relations at Mercia. But in this case, I think he's talking about the Northern VCTs, which we've had a few sort of newer ones. These are definitely not new VCTs. So I will hand over to Paul.
Unusual in this environment, and that the rest of the VCTs are presented to be the new entrants, whereas Mercia and the Northern VCTs have been around for a long time. In fact, around 25 years. We're turn of last century, the first VCT launched. So we'll walk you through what we're doing at Northern VCT. We've actually got an offer out at the moment, which I'll refer to later on. But as you will, everyone else has shown a risk slide. So of course, we're actually aiming this at financial advisors, this presentation. So yeah, treat it in that way. These are high risk investments, and there's a disclaimer at the bottom. So I'm one of the directors at Mercia Fund Management, which covers the Northern VCTs. It manages the contracts for the Northern VCTs. And there's three separate VCTs. I'll be referring mostly to the Northern Venture Trust, which is the oldest and most established, but just at the highest level, the three VCTs are pretty much the same. So I think it's 95% the same portfolio, and they're investing alongside each other in every deal that we do. But I think it's quite useful. The other VCTs are talking about what they're going to do, and maybe 10 to 50 million AUM. We're 416 million AUM, one of the most established VCTs, as I mentioned. We've got a long-term track record. You can see those stats on the left in terms of 1, 3, 5 years and 10 years track record as well. And that provides very good historical track record to point against from what our investment teams have been doing. I think there's also something we haven't really talked about yet around the tax side, but on the 1 year, Northern VCTs, Northern Venture Trust, it's 7%, great. But actually, if you think about the 30% income tax relief at the front and also the tax-free dividends, then you'll actually get a gross equivalent yield of 16.5 for additional rate taxpayer. So 5-7% in terms of dividends doesn't sound particularly exciting, but then actually when you think about it from the broader context, then actually these are pretty spicy investments, really, both on the risk side, but on the return side as well. So that's just the starting point of what we have done. We have got a £50 million offer out there. It's been up for about 6 weeks now, and I think we're just under £40 million filled in the last, say, 6 weeks. If you're going to move really quickly, we have our interim close, which is 5 o'clock today. And that enables interim shares to be allotted before the budget on the 25th, before the 26th, where the budget is. I don't think there's anything nasty going to come in the budget. I'm happy to talk about that later. I'm sure that's one of the follow-up questions. But we're thinking we're going to do an allotment anyway, so we'll put it just before the budget rather than after. And kind of the industry standard process and operations. In terms of Mercia, the broader group, so Mercia manages the Northern VCTs, 2 billion AUM, of which 416 is on the Northern VCTs, plus the offer which we've got live now. And so you can see it's a significant part of what we do within venture. And alongside, been lots of references to EIS today, but we kind of, where we operate is anything kind of pre-Series A is EIS, post-Series A is VCT, simplistically. And that's how there is some overlap for us, but minimal. So I think like less than 10 companies out of the 64 companies in the portfolio. So there is minimal overlap between the two strategies, and we kind of see them as different pools of capital, different strategies. There is some overlap, but they are different for us. In terms of how we do it, we are, as others are in the market as well, we are very much a regional investor. You can see on the map here all of our deals we've done. So there are an awful lot of deals around in the north, Manchester, Liverpool, Leeds. We've got a big presence up there. We've got 11 offices around the country. And we do obviously do deals in London. And yeah, for the VCT, it is a national investor, the regional focus. So it's we are Mercia and Northern are both referenced into the southeast areas, but we do look across the country for the best deals. And you can see some of the deals we've done on the right here. And some names you'll know, many names you will maybe not. But Harrogate Springwater was one of the ones which you'll recognise, I'm sure. Maybe Pure Pet Food, and I'll talk about one of them, the Beauty Tech Group, which was acquired, the current body in the top right later on, which definitely thinks a product that we could all use. It reduces wrinkles. So I think that's been, I'll reference that later on. But there's the type of things we do across consumer software and healthcare. So we'll talk about that later on. In terms of Mercia, we are one of the most active investors in the UK and actually potentially in Europe at the venture side. So I think that's probably understood already. Deployed about 300 million from the group last year. In terms of the VCT, it is the timeless investment philosophy you'll hear about before and again. So looking at the A-star teams and solving large and valuable problems. Yeah, so I think many of these things on the left is quite all the large VCTs established will be doing. We, as I say, we are investing probably a little bit later stage than the other VCTs on this call. But capital efficiency is always something that comes up again and again and again. We don't necessarily want to be putting lots and lots of money into a company and to get diluted in the future and get a reasonable exit. We want to get something which we can put some money in and then it can grow very well subsequently to give us a good outcomes. And I'll talk about some of the exits we've done. So and they're not all positive, and it is, say, a venture capital trust. So venture capital, you do expect failures. But actually on the longer term, as you can see by the performance figures earlier on, does come out pretty well. But what do the Northern VCTs invest into? So we're looking at kind of 6 to 8 companies per year, new investments between 3 and 10 million. Series A, as I said, and afterwards, and building out a decent position of equity ownership in those companies. We will do follow-ons as well, obviously, but we're looking to find new companies. We deploy 50, 60 million from the VCT into portfolio companies in this year, and hence we're raising 50 million, maybe more in subsequent years. We're going to go into the market every year and raise a significant size offer. In terms of sectors, I'm not going to go into too much detail, but software and AI, the Mercia Group has been in AI for a long time. We actually were one of the first investors into a company called Blue Prism, which was doing AI before AI was called that. So, and had a kind of 100x return out of that. And health and life sciences, that's probably what we're probably more known for. We've been investing into that space for a long time. We've got a lot of expertise in that space. Consumer is obviously the cost of living crisis of the last few years did tamper down what was going on in the consumer space, but people seem to have more money in their pockets nowadays and are able to purchase kind of luxury goods and holidays and things. And I'll talk about a few things like that in a minute. And deep tech's come up a few times. It's a little bit more ethereal, but it's more of the stuff that's underneath the hood. And we've got the various investments in that size. It's a smaller part of our investment strategy, but that's lining up with some of our other investments across the Mercia Group. We mentioned the sectors already, but you can see across. So software and AI is almost half of what we're doing. And then health and life sciences, 20%, consumer 25%, and deep tech other are small amounts. So but I would expect see more coming into healthcare and probably consumer as well, whereas software and AI, we're probably going to rebalance that down slightly over the next period, partly the valuations point, which I'm sure we'll pick up on later on. You can see that there are still some pre-2015 investments in our portfolio, but not many nowadays. We've sold them down over the last 5 years or so, and almost all of our investments are unquoted. I'll talk about one that's just gone quoted in a minute, which I already referenced in a minute. This is the 31st of March data. There's end of September data coming up before too long. So I said there's 64 companies across the portfolios. I would basically say that the three VCTs are almost identical. They've got actually slightly different share prices and slightly different dividend targets, but basically 5% dividend target across the board and delivering that. So the VCT Tech Group, I'll come back to that one later on. I've already referenced it. Pure pet food, and you kind of understand what that does. And you can see we've built out a bit of position of the VCT in that, and Rocker Pimbley. So you see it's all quite diverse, and some of the more established VCTs may see a big position in one company or another, whereas we're quite diverse, which helps with the risk reduction in many ways. There's a few exits, which I'll refer to just briefly. Gentronics for nice 4.5x. It was great. It's quite an old holding, but good outcome in the end. Climbing Hanger was one of those ones which didn't quite go quite to plan, and we did hit the limits for VCT, which is a challenge. So there are limits. You can invest into a company across state aid, which I know Brian knows well, and we can talk about if it needs to be. But that we did end up having a good exit in that in the end because it was at risk of failing totally, but somehow a decent outcome. And that's across these are just the NVT rather than all three VCTs. We put sort of more money into across each of these companies, but I'm not going to spend too much. Just to see on the right hand side, we do get zeros, write-offs. We do try and recover some money from any exits we get, but in some cases it's just not possible, and that's to be expected. But this is one of the good news stories. So this LED lights, so I say Brian doesn't really need this at all, but maybe I do and other people. But think about Kim Kardashian and such. This is a big consumer brand, and it's kind of reducing the wrinkles by shining LED lights on. I know some people within the people my friends group do use these. And we invested into the company in 2018. At that point, it had an £8 million revenue. We just listed it onto the LSE, London Stock Exchange, not on AIM, so the main market. It's about 140 million revenue and 300 million valuation, and it's up 10% today. So these are the sort of things you can do when you've been investing for a while at scale, and it's a great outcome for a UK business, and it's great to see. This is the sort of thing, and hopefully listing companies onto the main market may open up the LSE and hopefully see some good upward trajectory in the coming months, whatever happens in the budget. But I think that capital markets is quite a challenge in many ways, but we have realised a third of the investment, and we're going to be looking at the timeline to sell down the rest of the shares. But good example of a great success story within VCT investment. Briefly talking about dividends, we've been paying dividends for 25 years, and actually last year we increased on NAV as well as paying dividends, so which I think is quite unusual. So we're keen to keep on NAV going up and or flat to up, as well as paying out that 5+% in dividend, and I think that's what you can kind of think of Mercia and think of Northern VCTs, and this is kind of what we do, flat to increasing NAV and 5% plus on dividend. And looking forward, we have got great deal flow. We will deploy 50-60 million into portfolio companies this year. We'll come back to the market next year to raise more. We're always trying to be very careful about the pricing which we get into these investments. And we've got a very big network within Mercia to help build value within these portfolio companies, and hence we're able to generate those returns through exits. And yeah, I think that's a pretty exciting place to say. We've got about 10 million left of the 50 million which we're raising across the three VCTs. As Brian mentioned earlier on, we have closed N2 VCT, so we've got Northern Venture Trust and N3 VCT, so with between them about 10 million left. I doubt anyone's going to be able to move for the end of the day in about 4 hours' time, whatever it is. But if you can get applications and cash in by then, you can qualify for the shares allotted on the 25th, and hence also qualify for the interim dividend in January. But going on to something a little bit more contentious, yes, the budget's coming up next week, but actually if you look at last year's budget and before that, we had these tax efficient strategies Yes, ISA and pensions seem very different to the other strategies that we talk about and know well. But actually what I'm kind of seeing following 2024, we're seeing this from advisors. There is a bit of a squeeze on pensions and BR AIM because they're coming into IHT and in more inheritance tax liabilities. And I do think there'll be more money flowing into VCT and potentially EIS as well. I think that dynamic is quite interesting at this stage. And I think I'm kind of hoping that Rachel Reeves' plan is to kind of take money from various places and put them into UK companies via EIS and VCT. So that's my hope, or perhaps that's just a side effect. But on that note, I think that's all I have to say. Happy to answer any questions that you may have.
Thank you for that, Paul. And you've definitely been using that beauty face mask. One of the questions in, and I guess it follows on from what we've seen the last couple of years of the VCTs with some of the managers and consolidating the number of VCTs they have. And the question is around, given that there's a huge amount of overlap in the investments of the 3 Northern VCTs, why don't you merge them to reduce costs?
It's a fair point that there are some, they're actually not as large as you'd expect, but there is some economies of scale by having less VCTs. And we have talked about this and we'll keep considering it. But at this stage, historically, as I'm sure you know, that you can only invest a limited amount from each VCT, hence a lot of the market have multiple VCTs invested side by side. And it is partly a historic quirk, but I think we also see many advisors, financial advisors, who decide to allocate across all 3 to get more diversification. I have questions around that, if that's actually real diversification, because it's the same portfolio companies through the same manager with different trust structures. But that is one of the approaches that very many people do, because by default you get allocated across all the open VCTs. But yes, Steve, it is something we're thinking about, and we're on the case. But I don't think we. Well, I think it's a question we get asked quite regularly, and there is value of having multiple VCTs in terms of governance, because there's 3 sets of directors on those VCT boards have different experiences and different perspectives on the risks around the raises and the investments. So I don't think it's something we should ignore, but I can see some benefits in merging at some point.
Cool, makes sense. And then I guess it follows on from that to a degree, the raise amounts, and obviously N2's closed already because there was a smaller allocation in this raise to N2. How do you go about deciding that? Is it more to balance them so they're about the same, or is it a completely different approach?
Well, it actually references the previous statement in terms of the independence of the boards. So actually we've got 3 independent boards across those VCTs, and they are actually very independent, which is not always the case, I would say. And they have some different strategies, and sometimes one's got a lower dividend target, N3 has got a 4.5 dividend target rather than 5%, the other 2. And so there are some differences in kind of the wrapper itself. And sometimes the boards decide they want to raise, so we recommended that we raised 20 across each VCT, and N2 said, no, we'll only need to raise 10. So that's what happened. And so I think that governance point of independence is relevant here. But then we obviously looking at the cash amounts, and if we're investing across all 3 VCTs into one company, have to be cognizant of the relative amount of cash in each VCT, but that's just an operational point. But yeah, I think in due course we will be we're deploying more, we'll be raising more, and trying to service. There's a lot of demand out there, so I think we will fill our VCT within 2-3 months, definitely. But and that at 50 million, and I think because we're recognised to be one of the great market leader investors. So, but yeah, thank you.
Perfect. Hand back to Brian.
We do have a few minutes at the end, so I'm going to ask everybody to bring the screens back on. I think, Paul, we did get some questions that were relevant to sort of a pooled effort to reply. So I think we're going to give Steve a chance to ask 1 or 2 of those, and we'll see if we can get some further insights for everybody.
There's a couple, I guess, that tie in together. Someone had asked about should they wait until after the budget to invest into a VCT, and obviously we can't give advice on this, but I'd be interested to hear views. But then also, do you believe that the UK government policy is helpful or a hindrance to EIS and VCT investments?
Happy to take that as a first point. And yeah, so I sit on the board of the ISA, and there is a progressive expansion actually of the EIS and VCT kind of remit, with the sunset clause being extended and KI being introduced. So all the feelings we hear from the government is positive on EIS VCT, which is at quite a counterpoint in some ways to pension and IHT, which is quite interesting and kind of refers to my point about investing into UK SMEs, which is great. I don't think there's going to be any changes in the budget for what we're doing, but you never know.
I'd agree. I think the budget is unlikely to change anything directly for EIS and VCTs. The policy question is a more interesting one. Yes, the government does seem to be very positive towards both EIS and VCT. But if you take the question more broadly, there is clearly more they could do for our business in the UK in general. And certainly we find some of our companies are starting to find it easier to generate revenue overseas also than in the UK. Not all of them.
I don't think there's anything that we can sort of echo more, but yeah, I think UK PLC, cannot dig itself out of the financial hole that's created without new businesses, being invested into. So I think it's, unlikely to change. I think it's going to be here to stay for a long time.
AI has come up a couple of times in the presentations. People are looking ahead, and obviously we've got the budget ahead, potential headwinds, although we seem to be agreed here there probably won't be any changes that directly or hugely impact VCT and EIS. AI bubble has been talked about a lot. Has it burst? Is it going to burst? What's the feelings here and valuations around AI in general?
Well, every company wants to call itself AI these days, doesn't it? And what do you actually mean by AI? I did a PhD in AI. It was computer vision, 30 years ago. It's very different to what has then, been in some of the companies we've invested in, which are, much more the sort of conventional machine learning, to the generative AI you're seeing with LLMs now. VCTs, I don't think, are going to be playing in the big league of the particularly the US, AI companies. But we still see, considerable value in specific cases for AI where it's appropriate.
Yeah, just to sort of build off the back of that, I think AI enabled businesses rather than AI itself. VCTs just don't have the financial firepower, even if we all pooled all of our resources to get anywhere near what's going in from the US. So AI is the sort of macro, will ebb and flow. I think AI enabled businesses or businesses that are looking to use AI to sort of improve existing industries and efficiencies. I think that's an opportunity that will still maintain, even though there'll be some sort of fluctuations within the sort of big six, big seven, companies that are driving the markets. So, we're looking to sort of invest into companies that are effectively selling the shovels for the gold rush rather than the gold rush itself.
I suppose thinking about that question from an investor's perspective, I suppose the worry is, and there's been an awful lot written about the bubble, and I have no idea whether it's popped or is going to pop. But the worry is that the sort of concentration of listed assets in a relatively small number of very large businesses. And I do think that does play into this world. So, one of the features outside of tax reliefs of VCTs is accessing a different asset class. So I think, that's certainly where, VCT, if there's a bubble that bursts, it's going to impact absolutely everything. But I think, as Brian, you alluded to at the start, having a small proportion of your overall wealth in venture, unquoted, etc., I think can only help in terms of diversification.
I think more broadly, AI, the Mag 7, etc., they are creating efficiencies and revenue as well. So it's not a bubble without reason, and there are some very high valuations. The multiples are very high, and also the secular investments are a bit dubious. But I don't think it's going to be a big crash. I think there'll probably be a flattening for a while. And you've seen, actually, it's very pleasing to see the FTSE 100 thrashing the S&P for the last year, and long may it continue. Obviously, not all the FTSE 100 is representing UK PLC, but it's nice to be UK focused for once rather than S&P. But I think that there's a lot to go for across the UK in technology, and as we were saying about, there's a good diversifier away from those listed equities, which are quite volatile. Despite EIS VCT being high risk, you could easily lose 20-30% of your money on the S&P in the next 6 months.
Final question that's come in: what are expectations for an increase of tax on dividends and therefore impact on VCT returns?
No one else seems to want to don't want to hear my own voice at the time, but yeah, increasing dividends, income tax, whatever, that I think it's very unlikely to affect VCTs, and hence that's good for the industry, and it's probably not good for any of our personal finances, but it'll be good for the industry, and hopefully, again, as I said before, if people can be encouraged to invest into VCT and EIS and hence support UK SMEs, that's got to be a good thing.
Yeah, I'd echo that. I read a stat the other day that, you know, fiscal drag, which is the stealth tax that people are not, you know, fully aware of, is going to drag sort of in excess of 11 million people into the higher rate tax bracket. You know, that's almost a third of the workforce. So there is an increasingly more mainstream conversation for, you know, advisors to have with their clients around this. This is not just an asset class for the sort of super wealthy as it once was. You know, this is becoming more core mainstream financial planning, and Brian sort of mentioned it right at the start with, you can actually get some alpha out of your investment portfolio within VCTs and EIS as well as getting the tax breaks. So I think that's the message that I probably would take away if I were, you know, advisors. It's not just a narrow group that's being affected by this, it's affecting a much, much larger pool. And if it's not in your toolkit, you're at risk.
As Richard has cited my research, I shall thank him and agree quite firmly there. I think, I think, you know, VCTs are the more accessible end of venture capital relative to, you know, it's not that EIS is unattractive, but to get diversified portfolio just takes a bit more investment. So I'm going to draw it to close there. I'd like to thank everybody for attending, and I see almost everyone stayed to the end, so we really appreciate that. I hope you found it enjoyable, interesting. I'd like to give a big thank to Nick, Will, Paul, and Richard for their presentations and making it interesting. I'd also like to thank Steve for handling the Q&A. If you enjoyed the event, we have another EIS forum coming up in January, so look out for that. If you want more interest, we've got an EIS basic series, which is currently running on the podcast. So you can find that on YouTube, or we actually have a podcast version, so you can listen to that as well. Recordings will be available. Emails will come out soon. So if anything you missed or anything you want to refer to a colleague or friend, you can see there. If you want CPD, let us know, and we'll get that across. Thank you very much, everybody, and we'll see you next time.